Ladies and gentlemen, we are at an important inflection point in equity markets. Most of the prerequisite conditions that I had laid out in my previous videos for a sizable market crash to play out have all been met in recent times. So does that mean that a market crash is imminent now? And what about the melt-up call? What happened to this one last melt-up that I have long believed is likely to play out before this business cycle comes to an end? Is it still on the cards? Or have I given up on it? And last but not the least, is the current bout of volatility that we have been witnessing in the Nifty over the last 3 months anywhere close to an end? And is it time for us to buy this dip? Ladies and gentlemen, these are the very questions for which we are going to seek answers for during the course of this video. So please do watch out. Ladies and gentlemen, hi, this is my first video of 2025 and I want to start this video by wishing each and every one of you a very happy new year. My dear friends, 2024 was a momentous year for me and my channel by any standards. I started posting videos on my channel with some amount of regularity from March 2024 onwards. And even though I have managed to post only 25 full-length videos and 9 shorts during this time, kind of overwhelming love and support that all of you have shown for my content has ensured that my channel has gone from practically nothing to its current subscriber base of almost 25,000 subscribers. And all this has happened within a span of just 9 to 10 months. My dear friends, there is no way I can thank you, my dear audience, enough for the kind of love and support that you have shown for my content. So here's what I'm going to do. I'm going to start the new year by reaffirming my commitment to bring to you ever more high quality content that you can use to bring about tangible improvements in the outcome of your personal investments. Now coming to what I want to discuss in this video, which is regarding the wild ride that the Nifty has been on since September of 2024. The Nifty first hit a new all-time high of 26,216 points on 26 September 2024. But over the next 2 months, the Nifty corrected by almost 3,000 points. That's a correction of almost 11%. But from late November onwards, the Nifty once again started to rebound. And by 13th December 2024, the Nifty had rallied all the way up to 24,716 points. And in the process, the Nifty had recovered almost 50% of the cumulative correction of 11% that was witnessed in the Nifty between September and November of 2024. But this rebound could not sustain for too long. And after 13 December, the Nifty once again started to correct very sharply, correcting by more than 1,200 points within the span of just 1 week. And yet there is no end to the ongoing bout of volatility in the Nifty. And we can see that over the last 1 week or so, the Nifty has once again started to stage a recovery, rallying all the way to 24,189 points as of 2nd January 2025. And just as the Nifty was in the middle of this wild ride, I had shared a community post on my channel about 2 weeks back. This community post was titled 2 down, 1 more to go. And in this post, I had basically reiterated the 3 conditions that I believe must be fully met before a sizable market crash can materialize in the Nifty. Before we proceed, let's take a quick look at what these 3 conditions are all about. Well, when it comes to these 3 conditions, I didn't lay down these conditions in the recent past. I had laid down these conditions almost 9 months back in this video that I had published on 6th of April 2024. And in this video, I had suggested that before a sizable market crash in the Nifty can actually materialize, 3 conditions must be fully met. And what are these 3 conditions? The 3 conditions are these. The first of these 3 conditions, as you can see on your screen right now, was that the Fed should have started to cut Fed funds rate. This is the condition which ultimately got fulfilled on 18th of September 2024. The second condition that I had laid down was that the yield curve should un-invert, and this I was specifically talking about the 3-month 10-year yield curve. This condition also got fulfilled eventually on 13th of December 2024. The final condition that I had laid down was that the Fed's reverse repo facility, the RRP facility, should go down to 0. And those of you who have been tracking the RRP balance would know that the RRP is also on the verge of being fully drained. And ladies and gentlemen, it's in this backdrop that I had highlighted in my community post 2 weeks back that it's not a coincidence that the Nifty has become as volatile as it has just at a time when 2 out of my 3 conditions have been met, and even the third one is on the verge of being fulfilled. Now, since I shared this post about 2 weeks back, I have been inundated with messages and comments from many of you who have raised a number of concerns and sought a number of clarifications on my current market outlook. And that's why I thought it might be worthwhile to do a short but dedicated video to address these very concerns and clarifications that many of you have sought from me on my current market outlook. Now, when I go through your questions and clarifications that you have sought from me, I can broadly club these questions and clarifications into 3 buckets. First one is, now that my 3 conditions have either been met or is on the verge of being met, should we assume that a sizable market crash is now imminent and is likely to start anytime in the near future? The next one is related to my melt-up call. Now, many of you who have followed me on my YouTube channel for a while now would know that it's been my long-held view that before a market crash starts, I believe that before that, we will get one last blow off top in equity markets. We'll get this one last melt up in equity markets. And in the light of this long held view of mine, many of you have asked me if I still stand by my melt up call or have I given up on this call. Last but not the least, many of you have asked me what is the ideal way to position your investment portfolio at this stage. More specifically, most of you want to know if this is really the right time to buy the dip in the light of the steep correction that we have witnessed in the Nifty over the last 3 months. Now, to be honest, I have already answered all these 3 questions very, very exhaustively. And I've done so as part of this 3-part series that I recorded and published very recently, in which I discuss what are the key drivers of the current bout of volatility in the Nifty. Now, I understand that there's quite a lot of content to go through between the 3 parts of this series. In fact, end to end, these 3 parts account for more than 1.5 hours worth of content. And I suspect that many of you probably don't end up going through such lengthy videos end to end. And that's why probably many of you end up with doubts and concerns about something I have quite exhaustively addressed already in my videos. And that's why I thought it might be a good idea to do a very quick recap of this 3-part series with a very specific focus on addressing the 3 questions and areas of concern that many of you want me to address. Now, as part of this 3-part series, I had tried to focus on understanding the relationship between 3 key market parameters. The first amongst these 3 parameters is US government 10-year bond yields. The blue line that you see on your screen right now basically represents how the US government 10-year bond yield has moved over the last 2 years. What is US government 10-year bond yield? US government 10-year bond yield basically represents the yield, the rate of return that investors can get by investing in a US government 10-year bond. Now we are going to add this red line to this chart. This red line basically represents what is called the move index. The move index basically tracks the volatility in the US government bond market. And the way this works is that whenever you get a very sharp spike in US government bond yields, whenever you get a sharp spike in the blue line within a very short period of time, that usually also leads to a pretty steep spike in the red line, in the move index. So, for example, as recently as November of 2024, we got a big spike in the move index. The move index went to a high of 136. And why did the move index go to 136 around November? This spike was caused because of a very sharp spike in US government bond yields since September of 2024. Similarly, these are the other notable peaks that we have witnessed in the move index over the last 2 years. And each of these peaks was basically an outcome of US government bond yields shooting up very, very significantly within a short period of time, around the time that we got these peaks in the move index. So, each of these four occasions, as you can see, we got very significant spikes in US government bond yields, and that resulted in a spike in the move index as well. And a spike in the move index, which basically represents a spike in volatility in the US government bond market, is something that has a huge bearing on the Nifty here in India. And this is something that would, on the face of it, sound very unbelievable, but will become very clear once we look at the chart of the move index and the Nifty in conjunction. So let's do that. So for that, we will first take the chart of the move index a little up and then we will add the chart of the Nifty here. The blue line represents the Nifty, and as you can see, these two lines are almost perfect mirror images of each other. When the red line goes up, when the volatility in the US government bond market goes up, the Nifty usually trends downwards, and whenever the red line goes down, whenever the volatility in the US government bond market comes down, we usually witness very strong rallies in the Nifty. And this is what probably explains why we have got such a strong downtrend in the Nifty since September of 2024, because this has also been the period when we have got a very big spike in the MOVE index. In fact, if you look at the performance of the MOVE index and the Nifty in more recent weeks, you can see that there's been a very significant drop in the MOVE index from 136 to a level below 100 in November of 2024, and as a result, the Nifty also started to stage a rebound from late November onwards. So in summary, whenever you get a spike in US government bond yields within a short period of time, that usually leads to a spike in the MOVE index, and whenever you get a spike in the MOVE index, that usually leads to a downtrend in the Nifty. And this is exactly what has played out over the last 3 months. Over the last 3 months, US government 10-year bond yields have shot up from a low of 3.6% per annum to its current level of almost 4.6% per annum. That's a jump of 1 full percentage points over a period of just 3 months. And whenever you get such a big spike in US government bond yields within a short span of time, you're bound to get a spike in the MOVE index, and that is bound to lead to a downtrend in the Nifty, and that's exactly what we have got over the last 3 months. Now, based on this understanding about the relationship between US government bond yields, MOVE index and the Nifty, we can go about making an informed guess. This is not a definitive outlook, but an informed guess about how the Nifty is likely to behave in the days and weeks ahead if US government bond yields continue to remain elevated. And for that, we need to go back to a period in history, not very long back, but in the recent past, when we got a very similar spike in US government bond yields. And if we study the trend of the Nifty, the MOVE index and US government bond yields around that time, that can potentially give us some definitive clues about how the Nifty can potentially behave from here in the days and weeks ahead. So the period in history that I'm talking about is around late 2021, early 2022. This is around the time when the Federal Reserve in the US started to hike the Fed funds rate. The Federal Reserve started to hike Fed funds rate from January of 2022. And as soon as the Federal Reserve started to hike Fed funds rate, US government 10-year bond yields also started to trend upwards. As you can see on your screen right now, US government 10-year bond yields went up from 1.28% as of October of 2021 all the way up to 3.49% per annum by June of 2022. That's a jump of 221 basis points. What was the impact of this on the MOVE index? Well, this is how the MOVE index trended during that time. As you can see, because of this big spike in US government bond yields, the MOVE index also became very, very volatile during this time. Not just that, the overall trend of the MOVE index during this time was towards the upside. And what was the impact of this on the Nifty? Well, the impact of this on the Nifty was very, very adverse. Because of a MOVE index that was not just volatile, but a MOVE index that was trending towards the upside, we got a brutal 17% correction in the Nifty between September of 2021 and June of 2022. And this 17% correction, I believe, serves as a useful reference for us at this stage if we have to speculate on the scale of the correction that we are likely to get this time around. In fact, if I must hazard a guess, my sense at this stage is that the scale of the correction that we are likely to get this time around is likely to be less than what we got back in 21-22. Because the overall macroeconomic landscape that we have right now is far less adverse than what we had got back then. That was a period when the Fed was, in fact, raising Fed funds rate. Whereas right now we are going through times when the Fed is, in fact, cutting Fed funds rate. And as a result, the scale of the spike in US government 10-year bond yields that we have got this time around, which is about 100 basis points, is significantly lower than the scale of the spike in US government bond yields that we had got in 21-22. That's when the scale of the spike was more than 200 basis points. And that's why I'll be very, very surprised if the scale of the correction that we get this time around, peak to bottom, is more than, let's say, 15%. But that's not to say that that a 15% correction from the most recent peak that we have got in the Nifty so far is going to be without pain. A 15% correction from the Nifty's most recent all-time high is going to mean a Nifty at about 22,000 points. That's more than 2,000 points lower than where we are today. And going down 2,000 points further is going to be immensely painful. And how did the 17% correction in the Nifty come to an end? Well, the 17% correction in the Nifty came to an end because of a regime change from what I call the red zone to what I call the amber zone. And what are the indicators which confirm the onset of the amber zone? Well, as soon as you get an onset of the amber zone, as you can see, the move index, while it continues to remain very volatile, the move index is no longer trending towards the upside. Once the amber zone sets in, the move index starts trending sideways. Also, once the amber zone sets in, we get a very significant drop in the move index, and we also get an accompanying drop in US government 10-year bond yields. And because of a combination of drop in the move index as well as in US government bond yields, we get a reversal in trend of the Nifty as well. 17% correction comes to an end and the Nifty starts a slow and steady grind towards the upside. This is still not a breakout, but at least the correction has come to an end and the Nifty starts a slow and steady grind towards the upside. Now, if you contrast this to what is happening to markets right now we have got a very significant drop in the move index. The move index has come down from 136 to its current level of under 100. But we have not got any drop in US government 10-year bond yields. US government 10-year bond yields continue to remain stubbornly high. And as long as US government 10-year bond yields continue to remain stubbornly high, in my opinion, this correction is not over. And that's why the signal that I am looking for at this stage, which will confirm to me the end of this correction and onset of the amber zone, is a drop in the move index and an accompanying drop in US government 10-year bond yields as well. And once we get a drop in both the move index and 10-year bond yields, that in turn, that will finally confirm to me an end of this ongoing bout of volatility in the Nifty. In fact, I strongly believe that once the current bout of volatility in the Nifty comes to an end, we'll get this one final regime change from amber zone to what I call the green zone. The last time we got a transition from the amber zone to the green zone was back in March of 2023, which is when we got this big spike in the move index because of the bankruptcy of this small regional bank in California called the Silicon Valley Bank, the SVB. And as a result of this bankruptcy, the Fed started to intervene and inject liquidity into the US banking system at a very, very aggressive rate. And because of the Fed's aggressive intervention, after March of 2023, we can see that the move index finally started to trend downwards very, very decisively. And as a result of that, we got a very strong rally in the Nifty after March of 2023. And I believe that the onset of the green zone is something that we are likely to get before the end of the current business cycle. And I believe that we are likely to get it at some point in not too distant future when it becomes very, very clear that the US labor market is in a very, very tight spot and the unemployment rate is going up at such a fast pace that there is virtually no chance of inflation being able to stage a comeback. And once that happens, I believe from that point onwards, we are likely to see a decisive downtrend in both the move index as well as US government bond yields. And that in turn, I believe is likely to pave the way for this one last blow off top in the Nifty to play out, one last final leg of the melt up in the Nifty to play out. And I believe this last leg of the final leg of the melt up in the Nifty is likely to play out till the onset of a recession in the US, which is what I believe will bring the current business cycle to its eventual end. Now, coming back to these three questions, how does the thesis that I just presented help us answer these three questions? Let's look at these questions one by one. The first one, now that the three prerequisite conditions for a market crash to play out have been met or is on the verge of being met, can we assume that a market crash is imminent now? Ladies and gentlemen, my unequivocal answer is no. Well, as I just explained, I believe that the current round of correction that we have been witnessing in the Nifty since September of 2024 is not yet over. But at the same time, I do not believe that this ongoing round of correction that we are witnessing in the Nifty really marks the end of the current business cycle. As I explained a little while back, I believe that at some point in time in the not too distant future, the Nifty will find a bottom, and eventually we will very likely see a transition from a red zone to what I call the amber zone, and eventually even to a green zone. So I believe that once we get a transition into amber zone and eventually to a green zone, we will see a trend reversal in the Nifty. And to that extent, I do not believe that these three conditions having been met in itself necessarily means that a market crash is imminent in the near future. And when I talk about the eventual onset of a green zone at some point in time in the not too distant future, that automatically answers the second question as well. If you ask me, have I given up on my call for a final melt up? The answer is no. I still believe it's still on the cards. As I explained a little while back, I do believe that at some point in time in the not too distant future, it will become very, very clear that the US labor market is in a very, very tight spot. And that in turn will confirm that there's very little chance for inflation to stage a comeback. And that will pave the way for the move index and bond yields to trend downwards. And that in turn, I believe, is likely to pave the way for the final melt up in the Nifty to play out before this business cycle comes to an end because of the onset of a recession in the US. Now coming to the final and the most important question, is it time to buy this dip? The short answer is no. As I just explained, the time to buy this dip will be when we will transition from the red zone to the amber zone. The transition, as I explained, will happen when we get a decisive downtrend in both move index as well as US government bond yields. Right now, we have got a downtrend only in the move index. US government bond yields continue to remain stubbornly high. And as long as US government bond yields continue to remain stubbornly high, I believe that this correction is not over. And hence, till such time, I believe we should refrain from any aggressive buying in this market. In fact, if you want to understand the most potent risk to the Nifty at this stage, then you need to look at this chart. This chart shows us the historical relationship between the S&P 500 and US government 10-year bond yields. S&P 500 is basically the primary stock market index of the United States. And as we can see in this chart, these two lines historically have moved in tandem with each other, but in opposite direction. They have had a very tight inverse relationship. Whenever the red line goes up, whenever US government bond yields go up, the S&P 500 usually trends downwards and vice versa. But this is a relationship that has gone for a complete toss since September of 2024. Since September of 2024, as you can see, US government bond yields have continued to trend upwards, and that in turn has caused equity markets around the world to trend downwards very, very aggressively. However, US market has been one notable exception. The US market has so far managed to ignore the uptrend in bond yields because of the euphoria in the markets because of Donald Trump's election in the recently concluded presidential elections in the United States. But this is a rally which is now clearly starting to wane. There are very clear signs that the US markets are no longer being able to ignore the uptrend in US government bond yields. And I strongly believe that at some point in time in the not too distant future, the US markets will have to respond to stubbornly high bond yields and will have to trend downwards along with the rest of the world. And once the US market starts to trend downwards, that I believe will trigger the next round of correction in emerging markets, including here in India. And that I believe represents the most potent immediate risk to the Nifty in the near future. Ladies and gentlemen, before I end this video, I'm going to assure you about one thing. The coming days and weeks are going to present to investors risks and opportunities in equal measure. Navigating these markets through these risks and opportunities absolutely calls upon every investor to have a solid, data-driven, rules-based approach towards the market. At this stage, there is simply no scope to play the markets based on one's gut feel. And this is exactly what we bring to table for our clients at metacaps.ai. At metacaps.ai, we try to play the markets on behalf of our clients based on a rigorous rules-based approach. And how does the rules-based approach look like? Well, that's exactly what I'm going to present to you in next week's video. Next week, I'm going to present to you an overview of our proprietary AlphaSIP strategy, which is at the heart of how we navigate equity markets on behalf of our clients based on a rigorous predefined rules-based strategy. Ladies and gentlemen, this brings me to the end of this video. I know that I didn't present anything substantially new in this video, but it was important to reiterate something that I have already presented in order to clarify the doubts that were repeatedly coming my way from a very large section of my audience. I hope that you found the clarifications that I provided during the course of this video to be useful. If you did, then please do like and share this video, and please do consider subscribing to my channel. Thank you very much.